Hello and welcome to this month's episode of Capital Markets View. Hello Taryn, how are you?
I'm good, how are you, Chris?
I am good. So, volume figures. Here we go. So pretty good, like a good January, but
very good January.
Really chunky M&A and a lot of refi recaps.
Yeah, so it's the biggest monthly volume in about 2 years.
Yeah, it's
so
good.
It's been a really busy January. I think what's interesting, I mean, obviously there's been a lot of refis.
Yep.
Pricing is good, which we'll get to, and a lot of extension of maturities. I think at the end of the year we talked about how the maturity wall looked like it should be extended a bit further. Yeah. So we're seeing some of that. But I think what's really interesting is the M&A that actually it's been
big chunky ones.
Yeah, exactly. A lot of P2P in the pipeline we're hearing, public to private.
Yeah.
Fewer secondaries in the market at the moment. So, I think that is quite interesting to have this all at the same time.
But it's like you said, because of pricing, and we'll talk about that in a bit, it's really all firing off at the moment.
Yeah.
So let's link that into repricing and what's happening.
Yeah, so this includes the refinancings that are driven by repricings and also just repricing via amendment.
Yeah, okay.
And obviously, we're not quite where we were a little over 2 years ago.
Not far off.
But yeah, I mean, it's really accelerated, and that is driven by the pricing environment and technicals, which, should we go to the next slide?
Well, I was just going to say, but on this, so good credits, hang on, we've got pricing next? Yeah. So good credits are coming out, 3.25 on the spread?
Yeah, so I think the sort of flat B is like 300 to 325. Yeah. We're seeing that, which is, this is...
And this is yield to maturity, and that's final maturity, and it's also, so the overall yield including OID worked in, fees, everything.
Exactly. So it was 4.04% at the end of 2019, and now it's 3.85% for the 3 months to the end of January. So it is trending downward.
And I was going to say, in going forward, I mean, I personally can see nothing that's going to bring it up again.
Well, I mean, I think the sort of demand for loans, and we have a slide at the end about that, but that is just continuing. And, someone said to me at the beginning of the year when I met with him, he said, we just think the whole market's going to be repriced. Anyone who can will. Which makes sense.
Well, and especially, and linking it back into what you said about the maturity wall, push out your maturity, take down your price. Flexes, I mean...
nothing wider.
Yeah, it's all blue. I normally do it red, but flex down. Okay,
maybe we'll swap it Chris, next month. But December is a small issuance month. There weren't that many deals. But January, I think it was 18 flexes tighter. So that's quite a few.
So, and I always think the loan market's quite interesting the way it does flexes, because of course in the bond world you kind of figure out almost the perfect price and then you price your bond. Whereas in loan world, they're still not getting the almost the perfect price. They're still finding so much demand that they can flex it down.
Well, I mean, bond market, there's price talk, right?
Yeah.
So, I mean, I guess, it's
a different mechanism,
But we used to not have flexes at all, remember?
Yeah, no, I remember.
Or reverse flexes,
and secondary market and us versus what happens in the States.
Yeah, so I just think, I mean, it's just been quite a strong secondary market in January, which I found a bit surprising when you look at the primary issuance.
Yeah.
It's like, well, why is secondary so strong but I think the scale backs on allocations were so high that investors haven't had to sell ahead of their allocations. Also, repayments are quite high, so they have the room in their portfolio. They don't have to sell ahead of getting their allocations. So there's this. I mean, it did fall off a bit at the end of January, but throughout the month. The weighted average bid was climbing. But
I mean, I also think, of course, we'll talk about it a bit, CLO demand, warehouses, in Europe, 40 to 45 managers, everybody's got...
We're hearing 50 warehouses,
Easy. I was talking to, with all due respect to their relatively medium to small manager the other day, who said they had 2 warehouses open. A deal soon, another deal at the end of the year. So, and they were talking about buying in secondary. Because they had to fill the warehouse.
Yeah, they had to.
So bonds.
Bonds, yes. I thought we'd talk a little bit about bonds this month.
Because we don't normally, and I'm a loan person, so.
So I'll force you to. No, but it's just, I just wanted to point out that it's been a very strong bond month as well. And I think there is this expectation that we will see more bond issuance, more refinancing of loans in the bond market because their pricing is really tight. There's a lot of demand. And if you go to the...
I was going to say, no, just on this slide, I think, and that represents probably what, on balance, about 40% of the market, and loans at 60 this month? Yeah.
Yep. I mean, it varies month to month.
Yeah. And here's your pricing for...
Yeah, so this is single B versus double B coupon. For bonds, and it just goes to show you sort of how much B has come down.
And interestingly, and I mean, as a loan person, I always find this fascinating because, of course, in loan world in Europe, we don't have many double Bs, whereas in bond world they do. It's kind of fallen angels, it's people coming up, it's investment grade investors demanding that space to get yield.
Yeah, exactly. I mean, we didn't have all the data points, so there are fewer single Bs
issued,
in that time period, but yeah.
Okay, and then, here you go.
Oh, and this is just the comparison between the high yield senior secured bonds versus term loan B yields. So this is a bit more apples to apples, showing the yield to maturity. So that will show you why some issuers will say, and you know, if rates do rise, they're locking in rates at this very low level. So look, we'll continue to discuss this.
And also, I mean, the beauty of a loan is refi or repay at any time you want. Yeah. But you can put calls into bonds and get them back in a couple of years' time, and there's a degree of flexibility in bond world.
Well, yeah, there is flexibility on the term, so you can make them look more like or act more like loans.
Loan, okay, so and I must admit, when I saw this slide earlier, I found it quite shocking because, of course, we've just said huge amounts of issuance in January, isn't it great? Yeah. But then when you strip out...
So the net supply, so that's new issues tracked by the index minus the repayments. And repayments were very, very high in January. So that's why that net supply is very low.
Yeah.
And CLO issuance is very high. So we've seen a real swing from December. Now this is rolling 3 months, so it does take into account the months before. But I just wanted to show this to show sort of how much demand there really is, because CLO, as we always say, CLO is not the only picture of demand. There are lots of investors investing in loans outside of CLOs.
Because it's about 50% of the institutional bid. You've got all the managed accounts on top of that.
Exactly. So there's a lot of demand for the asset class, and at the moment, I don't know what people are saying to you, but everyone's saying to me they don't see any derailment of this unless there's a bigger shock. So far, coronavirus hasn't impacted at all in the loan market, but we'll have to see economically, how it impacts this cycle.
Yes, no, I completely agree. And here you go, AAAs versus term loan B. So, looking at the arbitrage of what works for CLOs.
Yeah, and with so many warehouses, what are the CLO managers thinking in terms of the arbitrage? I mean, we're hearing that they say there's quite a diversity of credits still out there. There are credits that are pricing at the tight spreads we talked about, but there are some that are not, the more storied credits. So, they're saying, well, we can barbell and we can, the weighted average spread for CLOs are still looking okay. I guess the question is, what impact will this eventually have on equity returns?
I think a lot of the issuance that's happened at the start of the year is actually warehouses that were built up last year with slightly higher weighted average spreads in them than what you would be getting now.
Right.
And what CLO managers are saying to me, bless them, of course they would, is that the liability side of their equation is going to have to come down a bit.
Yeah, exactly. Well, it's always the timing of that, right?
Yeah. As ever insightful. Thank you very much, Tara.
Thank you, Chris.
Okay. Hang on a second. Valentine's Day. No, we haven't got a slide with the hearts on.
Oh, well, happy Valentine's Day.
Yeah. So happy Valentine's Day to everybody. We hope you had a fun evening because it's a Friday when it comes. As ever, any questions for Taryn or me, please give us a call. Thank you.